Hey, what's going on? I trust all is well. I'm Brandon Anthony Clark, and if you're watching this video, you got a family you love, a career you're passionate about, and goals that get bigger and bigger and bigger every single year. And the last thing you need is something terrible and unexpected to happen to tear down everything you've worked hard for because you got a lot of people depending on you, right? That's why today I'm going to show you not just how I protect my wealth, but my health, my family, and everything I've worked hard to build over the last several years. In this video, you're going to learn how to protect your money from taxes, penalties, and market crashes, get paid if you ever get sick, injured, disabled, or die, safely grow your money, and even turn your regular everyday living expenses into tax-free income that you can use for whatever you want without any restrictions or penalties from your guy, Uncle Sam. And if your expenses are like my expenses, just think about being able to make a small percentage on all of the money you spend. Not just what you save, but also what you spend. And the best part, it's all done using a single life insurance policy that'll benefit you, your kids, your grandkids, and maybe even your great grandkids. And I know that sounds way too good to be true, but I'm going to show you how it works, why it works, and I'm also going to show you one of my own personal policies so that you can see that I'm not just talking about something, I know a little something. All right. So before we get started, let's get a little personal real quick. I'm 36 years old. I'm happily married. I got 4 kids. You might even hear them in the background arguing with each other while I'm recording this video. But I'll do anything in the world for my family. And I'm sure you can respect that because you likely feel the same way. I've built my business from the ground up without a dime to my name. I've taken a lot of L's and I've taken a lot of wins. Actually, the L's are the wins because the lessons are in the L's. That's how you learn how to win more, right? I faced doubters, haters, setbacks, criticism, had personal battles, and taken personal losses from close friends and family that I grew up with. But you know what? I've stayed loyal, I've stayed humble, I've stayed hungry, and I've stayed committed not to just making millions for myself, but creating millionaires out of people like you. That's my mission, that's my purpose, that's why I'm here. Let's get started. Now, most likely, you already have some kind of life insurance policy. But if you're not using it to do what I'm about to show you, then you're leaving money on the table. That's because there's a 99% chance that you have a term life insurance policy. Term life insurance is the most popular form of life insurance because it is the cheapest form of life insurance. But we all old enough to know we get exactly what we pay for, right? So when you have a term life insurance policy, it is simply a bill that you pay every month in case something happens. When something doesn't happen, then the insurance company keeps the money. Specifically with term insurance, because it's only going to cover you for 10, 20, or 30 years of your life. If you outlive the term, and there's a 99% chance that you will outlive the term policy expires, meaning you don't have the policy anymore, and all of the premium dollars that you paid, the insurance company keeps. Does that make sense? So that's why if you're in a financial position to own a life insurance policy, and when I say own a life insurance policy, I'm talking about having a cash value permanent life insurance policy, whether it's whole life or index universal life, do your best to get it. But there's absolutely nothing wrong with term life insurance. The important piece is making sure you have some type of protection. The problem is term life insurance only benefits your family when you die. Whereas the flip system is all about making your money work for you in the most efficient way possible to create a solid financial foundation. There's 2 main things that us as men have to do for our family. The first thing is protect. The second thing is provide. So how do we protect? How do we provide? Well, we go out, we make money. Whether we're building a business or we're helping someone else build a business, the goal is to go out and make money. Right? So there's 2 parts of your paycheck. You got a gross pay and you have a net pay. Within the flip system, you want to take money out of your net pay, which means you've already paid taxes on it. You're going to put it into this IUL, and your IUL is bundled with an index strategy. And I'm going to explain what index means here in a minute. IUL leverages 3 tax codes. It leverages tax code 7702, 101A, and 72E. And those 3 tax codes basically talk about how life insurance grows tax-free, you can access the money tax-free, and the death benefit transfers to your family tax-free. Now, this index strategy is very, very unique. Because what happens is as you put money from your net paycheck into this IUL, number one, you don't have to pay taxes again. Number two, when the market goes up, your money will go up with the growth of the market. But when the market goes down, your money will lock in and you'll get to keep all of the gains that you made. So the number one thing you'll never lose in an index strategy is your money. Does that make sense? Now, I don't want you to think that sounds way too good to be true, because there is a catch. The catch is you're typically capped at about a 10% interest rate per year. Sometimes the cap is lower than that. Sometimes the cap is higher than that. But generally, it's about 10%. And in some cases, there's no cap at all. No cap, no cap. And I want to keep it simple for today. Now, on the flip side of that, if the market were to ever crash, you are guaranteed a 0% floor. So effectively, that means what? You don't lose any of your money. So how does it work? Well, effectively what happens is the insurance company, when you pay that premium, they're going to take some of your premium and they're going to actually buy what are called options in the S&P 500. The S&P 500 is a collection of the top 500 companies in America, like your Apple, Amazon, Google, Tesla, Microsoft, Netflix, all those companies. And they basically give us an indicator of the health of the United States economy. And over the last 100 years, the S&P 500 has averaged about 11.5% annualized returns, including dividends. Now, that's important. Why? Because our returns are going to be linked to the growth of the S&P 500 without any of the downside risk. And why am I mentioning downside risk? Because even though the market has returned 11.5%, what happened in 2020? The market did what? It went down 30% in a year. In 2008, it went down 40% that year. What happened in 2000? It went down 40% that year. So even though we can get a lot of growth, the market goes up and down. And you don't want to be caught when it goes down. So effectively what happens with our IUL is what? Market goes up, money goes up. Market goes down, our money locks in. Okay? Now, for example, let me really just show you what effectively this looks like. So as I said, the insurance company, they're buying options in the S&P 500 or any index for that matter. And then the rest of the money goes into your cash value. So let's just say that year over year, the S&P 500 returns 6%, then they credit your policy 6%. Let's say the following year, the S&P 500 returned 8%, then they're going to credit your policy 8%. Let's say if the following year, the S&P 500 returned 15%. Well, if we have a 10% cap, then we get what? 10%. But let's say the following year, the S&P 500 does a negative 15%, which is actually almost what it did last year. Then we would get what? You get to keep all of your money. Does that make sense? So you weren't credited anything, but you didn't lose anything, because losing means you lost 15% of that, 15% of that, and 15% of that, which in all likelihood means you would have less money over here and you would have more money over here. Does that make sense? All right. Now, and I really don't want to gloss over these because this is really, really important. I want you to understand a few things before we move on to the next part. When you have an IUL, there's key benefits that you get. The first key benefit is protection. And I'm talking about protection for your money, meaning your principal, meaning your cash, your contributions are 100% guaranteed. Okay. The second thing is that your money grows tax deferred, just like it would in a 401k or an IRA. But unlike a 401k or an IRA, you can access this money tax free with no penalties and no restrictions. Okay. The third thing is that if you get sick, injured, or die, you or your family gets paid. Say that one more time. If you get sick, injured, or die, you or your family gets paid. And when I'm talking sick, like a heart attack, stroke, cancer, you lose a limb, you lose your eyesight, you need a kidney transplant, something catastrophic like that. Alzheimer's, I know that runs in some people's family. Anything chronic like that, your insurance company pays you, which means you don't have to go into your savings. It's important, right? Did you know the number one destroyer of most people's finances are medical bills? It's the leading cause of bankruptcy in this country is medical bills. Okay. Just recently this year, my first cousin, who was literally a brother to me, 4 months apart, we grew up together, did everything together. He ended up passing away unexpectedly. Same age as me, 36 years old. Just one day he wasn't feeling good. Happened on a Monday. He wasn't feeling well like all week. By the time he went to the hospital, his wife ended up getting a call saying somebody found him face down in the parking lot and he was in the hospital. He had suffered cardiac arrest and they don't know how long he was there, without oxygen. And unfortunately, he ended up passing away. And, that really just, I think about that all the time till this day because we really never know when our time is. And unfortunately, he didn't have something like this in place that could have, not saved his life, but at least helped his family out. You know what I mean? And I'm just sharing in hopes that if you don't already have some type of life insurance or some type of protection, just get it. You don't got to get it from me. Just get it. You know what I mean? So anyway, that's that. Number 4, disability. All right. Some index universal life insurance policies have a disability protection built into the policy. Number 5, your gains are locked in. So what does that mean? Okay. When I say your gains are locked in, let's say you had $100,000 of cash, and let's say your cash grew by 10% this year. Well, now you got 110, right? Your gain was $10,000. That means it is locked in. So even if the market goes negative 10% the next year, remember you got that 0% floor, meaning you still have your $110,000. It's extremely important and extremely valuable. Number 6, in some states, not every state, some states, your insurance policy is protected from creditors, lawsuits, and divorce. So this isn't just a life insurance policy that protects you when you die, literally protects you for all of these things while you're living. And these are just some of the, by the way, it is life insurance, right? We ain't even talked about how you can use this solution to turn your everyday living expenses into tax-free income you can use for whatever you want. And that's what we're going to talk about now. And then I'm going to give you an example. Okay. So the first thing that you have to understand when you want to take your regular everyday expenses and turn them into tax-free income using the flip system or this specifically designed IUL, and I'm going to stress that it is not just any IUL, it is a specifically designed IUL with a specific product because there's hundreds of IULs out there. Now, the first thing we have to talk about is cash flow. So cash flow is simply defined as income minus expenses equals cash flow. So let's just say you made $10,000 a month. And let's just say out of that $10,000 that you make every month, you got the mortgage payment, the car payment, the insurance, the groceries, the gas, the daycare, the gymnastics, the sports, the basketball, the football, whatever it is. You got people asking you for money every now and then that they don't pay back. I know how it is, right? Let's just say that adds up to $8,000 for the month. That means you got $2,000 every single month of positive cash flow. What are you doing currently with your positive cash flow? Are you putting it in your 401k? Are you putting it in an IRA? Are you buying stocks, cryptocurrency? Are you just using it and sitting on it as cash? Because there's a lot of things that you can do with your positive cash flow. But the reason why you usually save or invest it is so that it can go out and make more money for you. Because one day you don't want to have to work for money, right? So let's just say that you took this $2,000 and you put it in a place where you can average 7% interest on it. Well, that means you would make how much money? $140 for the month, right? And that's not bad, right? But I want you to look at this right here. This $8,000 is money that was spent. And because that money was spent, it could not make you 7%. The flip system gives you a way where you can earn interest on this full $8,000, right? How much interest? On average, 3% interest. So if you got a calculator handy, I want you to go ahead and calculate what the interest is at 3% on $8,000. I'll save you some time. It's $240 in the month. Now the question is, which one would you rather have? Would you rather have the 7% on the $2,000 that you can save, or would you rather have the 3% on the $8,000 that you spend? I hope you said both. Why pick one where you can have both? But you only get both if you have the flip system, which coincidentally enough is just life insurance. All right, so let me break down a quick roadmap to show you how this looks, and then I'm going to show you a quick snapshot of my policy. All right, so here's a basic explanation of the flip system and how you can essentially put your expenses to work for you. First, we start with your premium. That's going to be your rent, your mortgage, bills, and savings. Can't stress that enough. You have to be able to save money in order for this to work. All right. So your premium goes in. That's going to be your rent, your mortgage, bills, savings. After that premium goes into the policy, it goes into your IUL, which is this section here, and it'll earn an average 7% credit per year. And again, it's not a guaranteed 7% every year. It's a historical 7% average. So in some years it'll be more, in some years it'll be less. Remember, your gains are protected and your losses are avoided. After that money goes into your IUL, you're going to borrow against your policy, and you're going to borrow that money at an average cost of 4%. In some cases, it'll be more than 4. In some cases, it'll be lower than 4. In some cases, you can just lock it in at a guaranteed rate. We can talk about different options or loan options, which is why you want to have the absolute right specific policy, because you want to have the best loan options. Okay. Now that money's going to come back out with no penalties, no taxes. So if you're making 7% in your IUL and you're borrowing against your IUL at 4%, that means you're keeping the difference of 3%. Your cash value grows and continues to grow inside of your policies. That's effectively how you earn money on your expenses, even while you sleep, while at the same time protecting you if you get sick, disabled, injured, or die. Okay. So the way you look at this is like your own family bank. So for me personally, all of my money goes in as premium, give myself the opportunity to earn interest on it, borrow it back out, pay my bills. I'm keeping the difference. And if you just think about all of the money you've made in your lifetime up to now, and all of the money that you're going to make in your lifetime till the day you die, that's a lot of money. And I know you're going to spend a lot. So if you had a solution in which you could save a small percentage of your income over the next 20, 30, 40 years, in this example, this is $210,000 over a 65-year period, okay? And it pay you almost $40 million of tax-free income and pays your family almost $41 million of tax-free income. Why wouldn't you have it, right? I'd have 5 of them, and I actually do got 5 of them, okay? And that's what I want to show you here, because I don't believe in not doing it myself. So what you're looking at is a policy that I started back in October of 2020. And as you can see, we're looking at my account value, and currently it's at $193,935.29. And then you'll also see the net cash value, right? So your account value shows you how much cash you have, right? That's your IUL, the cash value, and that's what can earn your interest. Your net cash value shows you how much of your account value you can leverage. Now, the reason there's only 21,000 of that 193,000 in the policy that I can leverage is because if we scroll down, we will see that I have a total loan balance of $169,102.22. So if you take that 193 minus that 169, that's where you get that $21,000 difference between the middle. Okay. And so if you're thinking, and if you're still thinking, Brandon, okay, well, you're taking all these loans when you got to pay it back, and you got all this interest and stuff accruing at 4.6%, I want you to remember what I said. If I can borrow money from the insurance company at 4.65%, but I can earn an average of 7% on my full account value, then even if I'm borrowing the money, I'm still making money on the money that I borrowed. And you can too. In regards to paying the loan back, you can pay the loan back. However, I want you to think of something real quick. This is why you have to view an insurance policy as an asset. Did you notice this death benefit right here? So that death benefit is almost $2.4 million. This is money that is already owed to me by the insurance company. So that means when I take a loan from them and I don't pay it back, guess what they're going to do? They're going to deduct the loans from the death benefit of the insurance policy. Now, I can pay it back, but I don't have to pay it back in my lifetime. That's the key. That's the difference. And that's how you protect, insure, and grow your wealth in half the time as almost everybody else out there without having to pay taxes, penalties, management fees, and having all these crazy restrictions. It's just by strategically changing how you spend your money. Okay. Now, I'm gonna give you just a couple more snapshots here. As you can see, these are different crediting strategies that you can have with inside of an insurance policy. $193,935 total in the portfolio. And as you can see, these are the allocations, S&P 500, as well as some in the fixed account. And we have uncapped strategies, meaning whatever the market returns during that segment, I get the full return, no cap. All right. Also, a lot of people think that it takes years to do this, right? Like you got to build up a lot of cash in order to do it. In some cases, that's true. Meaning like if you're not starting with any cash, then yeah, you're going to have to build up some cash. But if you already got some cash built up, then usually you can just take that cash, start your policy, and begin doing this right away. All right. What you're looking at now is the accounting history. And the reason why I'm bringing this up is because if you remember, this policy was started in October of 2020. And what the accounting history shows you is a detailed outline of how this money went in the policy as premium and how these loans came out. And so initially what you're seeing is money going in, $6,000 a month, $6,000, $6,000, $6,000. Then on December, took a loan of $4,000. The next month we put in $6,000. And then the next few months, I just took out $900 and $900. The reason for that is because when you initially start up a policy, you want to do what we call front loaded. Save as much money in it as fast as you possibly can so that you don't have to save money in it for the rest of your life. Think about it like your house. If you could pay your house off in 5 years, why not pay it off in 5 years? Especially if it didn't cost you anything extra to do that. So as you can see, premiums being paid, which is rent, mortgage, bills, all that stuff, and then money's coming back out as a loan. So I hope this helps. I really wanted to show you my policy, not to brag, but just demonstrate that I practice what I preach. This is one of the best investments I have ever made in myself and in my family. And I just really wanted to share it with you. And I would love the opportunity to help you have one of these as well. So if you're ready for the next step, go ahead and click the link down below and we're going to help you step by step create your own custom design plan. That's going to include doing a complete financial analysis. That's going to also include helping you design the policy. Literally, we're going to take you and walk you through every element of the policy, including the cost, the fees, how to determine your premium, how to borrow and leverage money out of the policy so that it's a simple, non-complicated process. We're going to help you apply for the policy. We're going to help you service the policy for as long as you have it, which means we're going to meet with you every single year, and we're going to make any adjustments or changes that need to be made. If you're ready to get started, go ahead and click the link down below, and I'll see you soon.